Now, if you just take a look at this recent run up in yields that we've had since the start of August and even since the end of July, I've been doing some reading and looking at why these yields have been pushing higher, even as interest rate expectations were exactly the same in short-term interest rate markets. We've seen that a few times. Yeah, the sell-off in bonds, the rise in yields should be indicative of higher rates for longer, but it wasn't really reflected in the short-term interest rate markets. Now, from what I've read, it seems to be speculation that the neutral rate is going to have to be moved higher. Now, it was Tim Rayos who sort of started talking about the neutral rate needing to be higher and then backtrack that Powell won't think that. And I think that the risk here heading into Powell and Fed September meeting is these folks here are got ahead of the game. Now, even if neutral rates do have to be revised higher, even if the Fed do have to have higher rates for longer, is Powell likely to say that today? And is he likely to, the Fed as a whole, are they likely to rapidly change the economic dot plot and see much higher interest rates coming? It does seem unlikely, especially with that big US PMI miss that we had on Wednesday. The likelihood of a rapid repricing, we haven't seen an incredibly strong set of data that would seemingly justify that. So it just means, reflecting piece, that this could have been a bit of froth, a bit of anticipation, a bit of excitement that perhaps the Fed will have to go higher for longer. And maybe we'll start to see a pushback from that. Maybe it's got a little ahead of itself. So it does help the Fed, obviously, with markets expecting higher rates for longer. It does some of that heavy lifting for them. So the Fed's not going to be displeased with that. But if yields keep going up and up and up, then and the Fed is not going to be hiking interest rates high and will be cutting interest rates next year. If that's the case and that's the outlook, then the Fed will want to say that the market's getting ahead of itself. So the risk here is that we see a sharp sell-off back down to this 4% support level on yields. And I think that, if someone put a gun to your head and said, where do you expect these yields to go, higher or lower? I'd expect them to go lower. And remember, even bond traders, huge inflows into bonds this year. And even if yields do go up to 4.5%, 4.6%, will those big positions, will they be exiting them? Those big players? Very unlikely. They'll just try and hold it and wait for the eventual bid to come into bonds and the eventual downturn in the US economy. Now, if that doesn't materialize, then that's a different question, but that will be some way down the line. And just looking ahead, you would favor bids coming back into bonds. You would favor Powell not affirming that rise in yields, which has been on a little bit of speculation that the neutral rate is going to have to rise. Just some thoughts there of why the higher yield crowd. I think there's more risk of them being disappointed than their view being affirmed.